This is a video about a unique indicator known as FVG Channel. This tool combines two essential price action concepts, the fair value gaps as indicated in the name and the Fibonacci ratios to create these dynamic and effective trading bands. By merging these two concepts, the FVG Channel stands out as a significant improvement over similar indicators such as the Bollinger Bands. In this video, we're going to explore what makes this indicator so effective and how you can use it in your trading. Let's get into it. Now, to get started with this indicator, you want to go to TradingView, the trading platform that I'm going to be using. If you need to sign up, there's going to be a link in the video description for you to do that. And then you want to load any trading asset that you like. After that, click on Indicators and type in FVG Channel. Make sure to select this one by Lux Algo. Ladies and gentlemen, this is the all-powerful FVG Channel Indicator, and I know you may be thinking, so what exactly is it? This is a technical analysis indicator designed to visualize trends and potential market reversals by leveraging historical fair value gaps. It does this by constructing a channel based on the averages of recent unmitigated FVGs, allowing traders to interpret price movements within a structured framework. Now, an FVG, or fair value gap, if you didn't already know, is formed when there is an imbalance between buyers and sellers in a market, typically appearing as an unfilled gap within the candles. This is a bullish FVG, and this is a bearish FVG. These FVGs are used to form the outer bands of this indicator. So basically, to construct the upper extreme band, basically this line, the indicator averages recent unmitigated bullish FVGs within the chosen lookback period. Conversely, to form the lower extreme band, basically this line at the bottom, the indicator averages recent unmitigated bearish FVGs within the same lookback period. Now, how about this green dotted line at the top? Well, this is called the upper inner band, and it's formed using the Fibonacci number 0.786, which can be seen on the Fibonacci tool. What I mean by this is this. If we take a Fib retracement tool, and then you basically want to click on the upper extreme band, and then drag it all the way down to the lower extreme band, well, you can see that the upper inner band, this line, is located exactly at the 0.786 Fib retracement level. On the other hand, the lower inner band is actually located at the 0.236 Fib retracement level. Now, using this indicator to trade, specifically using retracements to these dotted lines, you will actually be trading based on Fib retracements, which is super helpful, and it's something you can't find on the Ichimoku cloud or on moving averages. Now, this line in the center is known as the midpoint, and it's actually located at the 0.5 Fib retracement level, and it's going to serve as the central axis point for this indicator's analysis. And that is exactly why this indicator is super unique, because not only do you get the upper and lower extreme levels formed based on recent fair value gaps, which fair value gaps by themselves are a very crucial concept in price action, but also you have these three inner bands, which are basically created from Fibonacci retracement levels. Now, looking at the settings of this indicator, you can see that you can actually change the lookback for unmitigated FVGs. An unmitigated FVG is basically an FVG that hasn't been retested by the price. For example, this is a bullish fair value gap, and then the price just went up without coming back to touch it. This is an unmitigated FVG. For me, I'm gonna change this to 10. The smoothing length. This determines the level of smoothing applied to the channel. Higher values are gonna reduce noise, while at the same time, they may delay the responsiveness of this indicator to price changes. So I'm gonna stick with the default value of 9. Now here, we can change the fill type. You can see we have options. We have gradient, single color, and no fill. We can change the colors of the upper extremities, the lower extremities, and the average, as well as for these options. The Style tab has several visual options that we can toggle on or off. After you've made your changes, click OK. Now, there is one fundamental question that I need answered, which is, what are these horizontal levels that we see right here? Well, these red and green horizontal levels are called breakout levels. When the price mitigates all FVGs in a single direction except for just one, the indicator will display a breakout level. This is the level that the price will need to cross in order for all FVGs in that direction to be mitigated by the price. Because of that, these levels can actually be considered as potential support or resistance levels. However, they should always be monitored for breakouts as well, because a substantial push above or below these levels would indicate strong momentum. So basically, this red level can be used as a resistance level, and then this can be used as a support level. Next, we have these up and down arrows, which are actually called bullish and bearish signals. These are printed whenever all FVGs for a single direction have been mitigated by the price, and an engulfing candle is printed. For example, you could have a series of bullish FVGs, but when the price comes all the way back down, basically mitigating or invalidating all the bullish FVGs, and a bullish engulfing candle is printed just after the mitigation, that is going to prompt the indicator to print a bullish signal like this. And the opposite happens when a bearish signal is printed. But of course, you would want to combine them with other confluences like support and resistance to take trades with them. Now, speaking of trading, how can we use this indicator to trade? Well, just like the Bollinger Band, the first and most obvious is gonna be to use it to identify the trend of the market. This is a bullish trend and this is a bearish trend. Now, you may be thinking, but how did you know the trend is actually bullish? Well, a bullish trend is gonna be identified whenever the price is consistently trading above the midpoint, as shown here. However, to consider the trend strong enough to be tradable, I would look for the price to remain above the upper inner band, the dotted line at the top. Now, for a bearish trend, the price, of course, would need to be below the midpoint. And then for a strong enough bearish trend, you would want it to be consistently trading under the lower inner band. Now, using this indicator for trend identification is just one of the methods of trading with this indicator, but there are other ways. Now, remember these buy and sell signals? Well, let me show you a strategy that you can use to trade with these signals. So, for example, if you have a red downward arrow, basically a sell signal like this, instead of just taking the trade on this engulfing candle, what you would need to do is to take this rectangle tool, draw it from the closing price of the engulfing candle all the way to the high of the highest candle during the swing high. And then you want to pull it to the left. And then roughly, you need there to be a previous resistance level, which was basically later retested by the price. The basic idea is to have a double top structure with these two resistance levels. So you have one resistance level, the price does a retest of the level, and it just so happens that during this retest, a sell signal was also printed by our indicator. Once you have these conditions met, you take a short position. Set your stop loss just above the resistance level, targeting a 1 to 1.5 risk-reward ratio, letting the trade run, and it was profitable. And of course, you just flip the conditions if you want to take a long position. Now, the next feature of this indicator that we can use to find ways to trade with it is the breakout levels, these red and green horizontal levels. So the way we're going to be using these to trade is right there in the name. It's a breakout level, which means we're going to be looking for the price to break and close beyond these levels to take positions. So for a long position, for example, you first of all want to ensure that the trend of the market is bullish by having the price consistently trading above the midpoint and as close to the upper band as possible. And then within that trend, you want to have an upper breakout level printed by this indicator. And then you want to have the price breaking and closing above the level with a comparatively large candle. So right here we can see that this candle is large compared to the last few candles. Not only is it engulfing, but it's also larger, which means that there is significant momentum and interest in this particular asset during this breakout. Now, if the breakout is a weak breakout with a super small candle, like if it were a tiny candle like this one, you wouldn't take the trade. So you take a long position here with a stop loss just under the most recent swing low. The take profit is going to be set at 1.5 times the risk, letting the trade run. and it was profitable. Now, even though we've explored two ways of taking these trades, my best method of trading with this indicator is to take trades based on pullbacks within bullish and bearish trends. Let me show you. Now, to take a long position, number one, you want to identify that the trend of the market is bullish. Of course, that is going to be indicated by having the price consistently trading above the midpoint. But for this particular strategy, we need it to be a strong enough trend. So you want it to be trading mostly above the upper inner band, this dotted line up at the top. Once we have that, we need the price to come all the way down and touch the dotted line with a wick, like it did here. And then we would need to have a green candle, which is going to be our entry candle. Ladies and gentlemen, this is our pullback. Next, we need to have a gap before the pullback, and it should be a gap of at least 15 candles. So you take your price and date range tool, you draw it from the pullback candle going backwards all the way to the most recent point, or the last point where the candle touched the dotted line, which is right here. So this is our gap, and as you can see, it says 50 bars. Our minimum is actually 15 bars, which means this condition is met. Also, for the trend, you may want to consider doing the same check, but with a minimum of 30 bars. So you draw it from the entry candle all the way to the last time the price touched the midpoint, and then you need the number of bars to be at least 30 bars. Right here we can see it's 119, which is way above the 30 bar limit, which makes this condition valid. Now remember, this minus sign doesn't actually matter. It's just there to indicate that we measured from the present going into the past instead of past coming into the present. Now, having these gaps is actually important because it prevents you from taking trades when the market is just moving sideways. All our entry conditions are met in this candle, so we take a long trade. The stop loss is going to be placed at the midpoint, which is this gray line at the center, and then you want to set your take profit at 1.5 times the risk. If we let this trade run, you can see that it was profitable. And of course, you can do the opposite of this if you want to take a short position. Now, here we have a short position. You can see the trend of the market was bearish because the price was consistently trading under the midpoint. And then we have a pullback that happened after a gap of at least 15 candles. So here, the red candle touched the dotted line with a wick, which indicates a pullback. Now, to know if we had a gap of at least 15 candles, you just take the date and price range tool, click on the candle, and then you want to drag it all the way to the last time a candle touched the dotted line, which is on this candle. And you can see it says 31 bars, which basically means 31 candles. Now, for the trend, we need to do the same check and to ensure that at least 30 candles also passed for us to consider the trend strong enough for us to take the trade. So we're gonna use the same tool and drag it from the entry candle all the way back to the last time it touched the midpoint. You can see this is the last time it touched the midpoint, and the number of bars was actually 52, which is good. Enter short position. Stop loss should be placed leveled with the midpoint. The take profit can be set at 1.5 times the risk. Letting the trade run, and it was profitable. In summary, the FVG Channel Indicator combines fair value gaps and Fibonacci retracement levels to identify trends, breakout points, and pullbacks, offering precise trading signals in trending markets. That's been it for this video. I really hope you found some value. If you did, remember to leave a like or even consider subscribing to stay tuned. Thanks for watching. See you next time.